Ever think there might not be enough people in China? Yeah, you heard that right. Even with their staggering 1.5 billion population, it's still not enough to fill all the real estate they've been building. How many vacant homes are there now? Each expert gives a very different number, with the most extreme believing the current number of vacant homes are enough for 3 billion people. That estimate might be a bit much, but 1.4 billion people probably can't fill them. Well, this doesn't sound bad at all. Who wouldn't want those problems, right? We could end the video here, praising Chairman Xi for solving the housing problem for 1 billion Chinese citizens and earning plus 100 social rating points, plus a waifu and a bowl of rice. But here's the real deal. China has been facing a real estate crisis for years, and it's making global headlines. There are 300 million Google results on this topic. The Chinese stock market has been plummeting for 4 years straight. For over 20 years, the real estate market added hundreds of billions to the country's GDP. But once the crisis hit, the trend flipped and development started burning money. There's even a dedicated Wikipedia page for this crisis. Despite potential risks from the Communist Party, I decided to dive into how the world's second-largest economy got stuck in a mortgage bubble, building so much real estate that it's now turning into ghost towns. Here's what's going on. The actual demolitions of 15 unfinished high-rises could be an epigraph for this video, or an epitaph for Chinese real estate development. It's not just concrete falling, but also the stock prices of companies. Remember, what you see on the screen aren't charts of some meme shitcoin, but top Chinese developers. These are multi-billion-dollar companies with massive real estate projects. And they were brought down by the following: 1, 2, 3. Real estate development is tough anywhere in the world. You can't just walk in off the street and start building. It takes years, and developers need huge financial resources, only making money once the project is completed and sold. This involves big, long-term investments. There are 3 ways to find this money. First, use revenue from previous projects. Second, sell apartments at a discount during construction. Third, attract funding. Loans. This has to be loans. And you're going in the right direction. China is currently undergoing a major systemic crisis. In reality, the real estate market can't survive on revenue from finished projects alone. In China, sales accounted for half of the funding, which is pretty impressive. The other half came from loans, with only a small portion coming from banks. Most of them are independently sourced loans. The loans were needed to keep up with the building boom that started in 2009. Yep, when the Western world was dealing with the aftermath of the 2008 mortgage crisis, China experienced a construction boom. The middle class was on the rise. To give you some perspective, in 2009, developers issued bonds, those independently sourced loans, worth $675 million. 11 years later, in 2020, they issued bonds worth $65 billion. That's just in 1 year. Rapid growth comes with headaches. Half of all problematic bonds were developer bonds. In 2020, Chinese regulators finally admitted the huge risk and called it a black swan. Well, not this time. They called it a grey rhino. Real estate is the biggest grey rhino in terms of financial risks in China at the current phase. Property-linked loans in China now account for 39% of total bank loans, and a large amount of capital from bond, equity and trust investments have flowed into the real estate industry. Experiencing painful flashbacks of the American 2008 crisis, authorities summoned the 12 largest developers for a meeting where they laid out 3 red lines on a board. The red lines are just a fancy name for restrictions. Here they are, top to bottom. No need to pause the video, just get the gist. Authorities severely restricted developers' ability to attract new project funds until they paid off their current debts. Everything could have been great if each of the invited companies hadn't already crossed at least one line, and one of them crossed all 3.
Evergrande.
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 The butterfly effect. When a small event triggers a chain of catastrophic events far exceeding it, like the outbreak of a new virus in one of China's cities. In our story, the small player that's going to be a trigger is a developer named Fantasia, ranked 64th in the industry. Total debt is $13 billion. In October 2021, Fantasia was supposed to make a bond payment. Standard practice. The scheduled payment was $206 million. Let me guess. They couldn't pay up. Nope, it gets juicier. Eastern politics showed itself in all its glory. So in October, $206 million was due. Did Fantasia have the money? As an investor, how would you feel knowing that in late June the company had $4.2 billion in their account? By late August, the cash had dropped to $1.4 billion. In September, they repurchased their own bonds for $6 million, signaling that they were doing well enough to buy back some debt. At the end of September, they sold the division to a major player for $500 million, while the bond payment had to be just $206 million. So Fantasia had the money, but on October the 4th, they decided just not to pay. After the 3 red lines came into effect in early 2021, Fantasia's business, which relied heavily on borrowed funds, couldn't keep going. The company managers probably knew this earlier, but on October the 4th, they made it public. By not paying off their debts, they not only declared default and scammed investors, but also wreaked havoc on the whole real estate sector. The Fantasia default on $206 million of dollar bonds, October the 4th, caught the market by surprise and caused the sell-off to intensify. Only 2 weeks before the default, the company said its operating condition was good and it had sufficient working capital and no liquidity issues. If this happened to a developer ranked 64th, just 10 months after the 3 red lines were introduced, what's going to stop it from happening to someone in the top 10? When Fantasia defaulted, investors thought, if it happened once, it'll happen to the whole sector, and dumped Chinese bonds. Fantasia's default exposed issues across the construction sector. Just a couple of weeks later, on October the 18th, the next company, Cynic Holding Group, defaulted on its bonds. You don't need to remember the name, it's just another company unable to service its debt. Whether they had money on the balance sheet or not is irrelevant. What matters is that in 2021, the deep crisis in Chinese real estate became clear to everyone. It became a self-fulfilling prophecy. Investors stopped trusting Chinese developers, fearing more defaults, and developers lacking new investments indeed faced a liquidity crisis. It wouldn't have been so bad if it hadn't hit the big players. You've definitely heard of this one, China Evergrande Group. And no, not the ship that got stuck in the Suez Canal. Evergrande isn't just one of the largest real estate operators, they also made electric cars, raised pigs, made movies, produced baby food, bottled mineral water, and even dabbled in medical robotics and supercomputing, a real pillar of the Chinese economy. If you thought Fantasia's $13 billion debt was huge, check out our pillar. It's $300 billion debt. But even a crazy number like that can just reflect the holding's size. If they can service their debt and generate revenue, it should be fine. But in our story, one problem triggered a chain reaction of new ones. On the screen, you see a comparison of the investment habits of the West and the East. While Americans go for financial assets, conservative Chinese prefer to park their money in tangible real estate. But in 2021, with the red line restrictions in place, faith in real estate investments crumbled, and so did the price per square meter. Now let's recall where developers get the money to complete projects. 1/3 comes from those infamous bonds. Over half comes from sales. Both sources were drying up, and this was happening while the government was pushing for debt reduction. So, companies just ran out of cash sources. This led to stalled construction projects, empty homes, and a new wave of defaults. The spiral kept unwinding, and this is far from over. In December 2021, 2 months after Fantasia, the giant Evergrande defaulted. Another 46 developers followed. If you think it ended in 2022, nope, 2022 brought even hotter red lines. China's crisis continues. In 2023, 2 more top developers out of top 4 missed payments, Greenland and Country Garden, the largest Chinese developer in recent years. By then, they had 3,121 unfinished projects, 4 times more than Evergrande. Of the 4 elephants of the construction industry, 3 were on the brink of bankruptcy. That's enough! With these words, on January the 28th, 2024, Judge Linda Chen wrapped up the months-long hearings on Evergrande. The next day, she ordered the liquidation of the holding, thus ended the 28-year history of one of China's largest developers. But the problem isn't with one developer, or even the construction industry as a whole. It runs much deeper. Remember the rule of the 3 red lines that cut developers off from borrowing? Money runs out, revenue from apartment sales hasn't come in yet, so they have to default because they can't borrow more. But if you really want it, you can do it.
Just do it!
How did the authorities figure out the company's debt sizes? Obviously from their financial reports. So, to get around the rule, developers needed debts that didn't have to be reflected on the balance sheet, and they found a way. Developers started creating offshore companies that issued their own bonds under their guarantee. And the kicker, the guarantee was valid all year round except for June the 30th and December the 31st, meaning these obligations didn't appear on the balance sheet because they weren't there at the time of reporting. Smart, simple, and slick. In addition to this, Chinese construction companies found ways to attract funds without showing them on the balance sheet. Loans? No longer an option. Bonds? Off the table. So, who comes to the rescue? For this nostalgic reference, like the video.
Let's get dangerous.
In reality, shadow banks come to the rescue. These aren't like Masonic lodges, just financial institutions that essentially function like regular banks but aren't subject to the same regulations you see on the screen. Hence, they're shadow banks operating under the radar of regulators but ready to invest in risky ventures. And this isn't just a powerful sector, it's a hell of a powerful sector. Estimates of its size range from $1.5 trillion to $11 trillion. If you think this phenomenon is exclusive to corrupt China, you're wrong. The IMF reported that in the US, shadow banking is valued at $15 to $25 trillion, and in the Eurozone, it's $13 to $22 trillion. Shadow banking tends to take off when strict banking regulations are in place, which leads to circumvention of regulations. It also grows when real interest rates and yield spreads are low and investors are searching for higher returns. Strict banking regulations and low traditional returns. These are the conditions for the emergence of institutions willing to invest in risk. All these conditions were in China. Add to that a decade-long real estate boom and it was bound to happen. Here are some examples of shadow bank investments in developers. The party of easy returns continued as long as the average Zhang Wei kept buying apartments. But in 2021 he stopped, and as a result, in the first half of last year, 106 shadow banking products defaulted on a total of $6 billion. You recently saw how the Zhongrong Trust invested in developer projects. What? Never heard of Zhongrong. Well, just recently there was a table here. Funny how you're quick to comment on geography and borders, but skip the crucial points. So, Zhongrong Trust is partly managed by one of the top 10 shadow banks. Meet Zhongxi Enterprise Group. I learned about this company recently, and as you might have guessed, things aren't going well. Well, they were, but at the beginning of this year they filed for liquidation. Their debt was almost $65 billion. Smaller than Evergrande's, but the important part is the liquidity crisis has spread from the construction sector to the financial sector. Remember, China's shadow finance is valued at around $6 trillion. That's slightly more than Germany's economy. Who still thinks $300 billion is a lot? Chinese developers, like American bankers, believed in endless demand for housing and started issuing bonds, building, selling, issuing more bonds, building, selling, and so on. Unlike American authorities, the Chinese government saw the real estate bubble inflating. They realized the demand would soon dry up, there'd be no one left to sell to, and developers would be stuck with tons of bonds they couldn't pay off. Failing to cool this market with economic measures, and they really tried, the authorities moved to direct intervention and simply banned lending to anyone with already large debt. This decision shattered the developers' business model, halved their cash flow, and triggered a liquidity crisis. That, in turn, caused an exodus of investors and falling prices, starting a feedback loop. In an attempt to plug the financial holes, developers dove into shadow banking, taking up more debts there, delaying their downfall by a few years but dragging shadow banking down with them. We're here now. Will the shadow banking system hold up, or will it also collapse alongside the construction industry? Will the crisis spread to the entire Chinese economy and then to the world? Or can this process still be stopped? I can't say. For now, we're just watching the frightening yet fascinating spectacle of the collapse of China's economic miracle after 40 years of explosive growth. You know who to share this video with. We thank everyone, especially the backers of the researchers industry's non-guaranteed bonds on Patreon. And I'm the researcher.